Welcome to Stealth Trading. When we first enter the world of trading, most of us carry a sweet illusion. If I just master the technicals, read the indicators right, follow the trend well enough, I can make money easily. And in the beginning, especially if we're lucky or the market is favorable, those first winning trades only reinforce that belief. This is simple, but time goes on, and slowly, the losses start creeping in. One losing trade, then two, then three in a row. And doubt begins to grow in your mind. You ask yourself, but I analyzed it correctly. Why did I still lose? And then it happens. A losing streak. 5 trades, 7 trades, 10 trades in a row. And it's no longer about technical mistakes. Sometimes the market simply doesn't move the way you predicted. The worst part? You blow up your account or lose so much that you're mentally shattered and can't keep going. Here's the truth. Trading is a game of probabilities. It doesn't matter how good your strategy is or how experienced you are. Losing streaks are guaranteed. No one escapes them. So the real question is no longer, how do I avoid losing? But rather, how do I survive when I lose? The answer lies in a skill that sounds simple, but determines whether your account lives or dies. Capital allocation and risk management. If you don't manage your capital properly, just a moderate losing streak can wipe you out. But if you allocate your capital wisely, you can survive even 10 losses in a row and still have the strength to get back up, reflect, and wait for your next real opportunity. In today's video, we'll break down why proper capital allocation is critical to your survival, how to apply the 1-2% risk rule in real trading, how to size your positions based on entry and stop loss, how to stay mentally stable during losing streaks, and finally, how to build a long-term mindset to thrive in this brutal game. So, are you ready? Let's dive into part 1. Why capital allocation is a matter of survival for traders. When you're new to trading, you likely believe this one thing: if I just analyze the market correctly, I'll win. But the market is far more brutal than we expect. No matter how skilled you are, or how well designed your system is, there will be times when you lose trade after trade. Trading isn't just for smart people. It's for those who know how to manage risk. And the first thing you need to understand is this: survival matters more than instant victory. Let me give you a scenario. Suppose you have a $10,000 trading account. You risk 10% of your capital on each trade. That's $1,000 per trade. Just 5 losses in a row, and you're down 50%. You're now left with only $5,000. At that point, just to get back to where you started, you need to make a 100% return on the remaining capital, an almost impossible task, both technically and emotionally. Now let's imagine a different scenario. You still have $10,000, but this time you only risk 1% per trade. That's $100 risk per trade. Even if you lose 10 trades in a row, you've only lost $1,000. That's just 10% of your account. You still have 90% of your capital, and more importantly, a clear mind to keep going. You're alive. You can still fight. This is why capital allocation isn't just important, it's everything. Trading is a marathon that spans years. You don't win by going all in on every trade out of ego or excitement. You win by protecting your energy, your capital, and your emotional resilience. Many new traders are overconfident. They backtest a high win rate strategy and think, I've got this. But the market doesn't care about your backtests. There will be phases where even the best strategies fail repeatedly due to unexpected volatility, major news events, or just the pure randomness of trading. And if you're not ready with proper capital management, the market will wipe you out before you ever get the chance to succeed. There's a popular saying in trading: when you lose, lose small. When you win, win big. To achieve that, you need more than a good strategy. You need a smart risk model. If you bet too big on one trade, One bad outcome can erase everything, but if you keep your risk small, each loss is just a scratch, something you can recover from. The most fundamental rule that every professional trader follows is this: risk only 1% to 2% of your account per trade. If you have a $1,000 account, risk no more than $10, $20 per trade. If you have a $10,000 account, your max risk is $100, $200 per trade. By limiting your risk as a percentage of your account, you give your capital resilience, a cushion to absorb losses without collapsing. More importantly, proper risk sizing keeps your mind stable. When you know you're only risking a small portion per trade, you make clearer decisions, stay patient, and stick to your system, even through losing periods. Remember, in trading, the result of one trade doesn't matter as much as whether you're still alive after 100 or 200 trades. To survive long enough to succeed, your capital strategy is what separates the winners from the wiped out. And this story resonates with you. Don't forget to hit the like button so we can share this value with more people. And if you know someone who needs to hear this, share it with them so they don't have to wander lost like we once did. Thank you. Have you ever asked yourself, if I lost 10 trades in a row, how much of my capital would I have left? It might sound extreme, but in trading, this is a very real scenario. And the ability to survive such a losing streak is what separates long-term traders from those who are wiped out within months. Picture this: you're trading gold against the US dollar. You've done your analysis thoroughly, marked your support and resistance levels, checked the news for FOMC updates, and studied both the 4-hour and 1-hour charts. You decide to enter a buy trade at $19.50, expecting the price to climb to $19.80. You place your stop loss, $20 below your entry. But the price doesn't go your way. An unexpected news event sends gold sharply downward. Your stop loss is hit. You lose 1% of your account, just as planned. You stay calm. You analyze again and enter another trade, this time a sell at $19.40, expecting a drop to $19.10. But again, the market reverses quickly. Another stop lost, another loss. Now you've lost 2 trades in a row. Your mindset starts to waver. You begin to doubt yourself. Am I wrong? Am I not cut out for this? You keep trying, but your confidence is shaken. And when your emotions are in turmoil, your decision-making deteriorates. You become reactive instead of calculated. Then you lose the 3rd trade, then the 4th, 6 in a row, then 7. A 10-trade losing streak is absolutely possible, even for experienced traders. Now let's talk numbers. If you're risking 1% per trade, after 10 consecutive losses, you're down 10%. A $10,000 account becomes $9,000. Not ideal, but still very manageable. But what if you were risking 5% per trade? After just 2 losses, you're down 10%. After 5 losses, you've lost 25%. After 10 losses, most of your account is gone. And with it, your emotional stability, your patience, and your belief in yourself. This is why risk management and capital allocation matter more than any entry technique. Smaller position sizing teaches you that one trade does not define you. Even a streak of losses doesn't say everything about your ability. Trading is a game of probabilities, and if you're disciplined and patient enough, you'll outlast the storms. Remember, you don't trade just to win today. You trade so that 3 months, 6 months, a year from now, you're still in the game. The market doesn't care who you are. It doesn't care how smart you are or how much experience you have. It only rewards those who protect their capital, control their risk, and accept losses as a natural part of the process. So, are you mentally prepared to lose 10 trades in a row? Are you ready to build a capital strategy that lets you survive the chaos? If your answer is no, then this is the time to start. Because without a solid risk plan, just one bad day in the market can erase months or years of hard work. money, and self-belief. Once you understand that capital allocation is your life jacket, the next question is, how do you actually do it? Let's walk through it step by step. Start by deciding the maximum amount you're willing to lose per trade. Most seasoned traders recommend risking 1% to 2% of your total account on a single trade. Let's say you have a $10,000 account and choose to risk 1% per trade. That's $100. You analyze the gold USD pair. Price is currently at $2,000. You expect gold to rise, and you plan to place your stop loss $20 below your entry at $1,980. So your max loss is $100, and your stop is $20. To find your trade size, divide your risk amount by your stop.
$100, $20, 5. That means you should enter with 0, 5 lots or 50 micro lots depending on your broker and account type. You see, position sizing is not emotional. It's not random. It's math. It's logic. It's non-negotiable. But many beginners make one fatal mistake. After a loss, they feel they have to win it back quickly. So what do? They double their position size, or even triple it, just to recover. And that's how accounts blow up. I once saw a friend with a $10,000 account lose everything in an afternoon. It started with a small $200 loss. Then he doubled down, lost again. Then he quadrupled. And 5 trades later, it was all gone. I asked him one question. Did you come to the market to build lasting wealth, or to gamble? Have you ever asked yourself that? Trading requires you to be cold, rational, and principled. No one wins all the time, but those who manage risk, who survive the worst stretches, they're the ones who make it long term. I've been there too. In my first year trading gold, I had a streak of 7 straight losses. Each time I told myself, I just need to win the next one. And then I made the classic mistake. I increased my position size. Within 2 days, my $3,000 account had dropped to under $1,200. That feeling, like someone tightening a noose. Shame, frustration, self-doubt. But I was lucky. I stopped before it was too late. I sat down and wrote a strict risk management plan. I would risk only 1% per trade. I would accept 10 losses in a row if needed. But I wouldn't ever increase size out of emotion again. That's how I survive. You don't need to hit home runs. You just need to not strike out. Stay in the game. Stay alive. A true trader is not someone who wins a few trades and starts thinking they're a genius. A true trader is someone who knows how to accept losses, protect their capital, and stay committed through the entire journey. Are you ready to become that kind of trader? Remember, risk management isn't there to limit you. It's there to protect you from yourself in your weakest moments. Think of each trade as a single brick in the foundation of your success. No brick is overly important, but one by one, step by step, those bricks build the castle you're aiming for. Now that we've reached the end of this story, a story full of lessons from failure and growth, I hope you can feel just how essential capital allocation is in trading. So let's sit back, take a deep breath, and reflect. Imagine losing 10 trades in a row, but on each trade, you only risk 1% of your capital. In total, you lose 10%. That means you still have 90% of your financial power to keep going. Your account isn't blown. You don't need to revenge trade in desperation. You can calmly sit down, review your trading journal, adjust your strategy, and wait for your next opportunity. Now I ask you, isn't that a precious feeling? While so many traders out there blow half their accounts after just 5 losses, you, thanks to smart capital management, are still standing strong on this turbulent ship we call trading. What's the biggest lesson here? It's not that the best analyst wins. It's not that the best forecaster survives. The one who survives is the one who knows how to protect their account from storms of failure. Because at the end of the day, trading isn't a game of who gets rich the fastest. Trading is a game of who lasts the longest. Each trade is a single brick. Whether you end up building a sturdy house or watching it collapse, It all depends on whether you still have enough bricks left after the storm. So if you've just lost 10 trades in a row, don't panic. Ask yourself, did I manage my capital properly? Did I violate my max risk rule? Did I stick to my trading discipline? If the answer is yes, then you are on the right path. A losing streak is normal. You didn't fail just because you lost. You only fail when you lose all your capital, all your discipline, and all your belief in yourself. So treat losing streaks as an essential part of the journey. You don't need to win every trade. You just need to win across the long haul. And to do that, risk management is your most faithful companion. If there's only one thing you remember from this video, let it be this. Capital allocation isn't about winning fast, it's about staying alive. And every day you survive in the market is one day closer to success. Thank you so much for staying with me until the very end of this video. I know this path isn't easy. It's lonely. It's brutal. It tests your faith and your patience, little by little, every day. But you are not alone. There are many of us, like you, like me, still learning to master ourselves amid the wild waves of the market. If you found value in this video, stay tuned for the upcoming ones. Together, we'll dive deeper into how to build a personalized capital management strategy, how to recover your account after a losing streak, how to maintain mental strength when the market tests your patience. Each video will be one small stone to help you lay a solid foundation for your long-term trading journey. Let's walk this path slowly, but surely. Let's learn to survive, learn to persist, and finally, learn to win the right way, the sustainable way. Thank you once again. I'll see you in the next video. There's still so much ahead of us.